Today we look at all things interest only, from the advantages to the disadvantages, and even a case study from one of our recent customers considering their interest only options. And remember, if you like this video, it'd mean the world to me if you could hit that subscribe button. One, what is an interest only loan? So an interest only loan is essentially a loan you never pay off. And if we look at a graph, it's quite easy to see how this works. So on this axis, we've got the loan amount, let's call it 300,000. And on this axis, we've got the time. So let's call it 30 years and 0 years. So an interest only payment, if we look at it graphically, would look like this. Essentially, the loan amount is never paid off. Think of an interest only repayment as a rental. Like rent, you never get to own the property, but it affords you the ability to use the premises. Much the same, an interest only term allows you to keep the facility, which is a loan amount, in this case 300,000. However, it never allows you to keep it or to pay it off. Two, commonly asked questions. The first question we get asked a lot is whether or not you can have an interest-only term for an owner-occupied premises. The short answer to this is yes. Lenders will consider it. However, it is always based on a case-by-case scenario. And let me explain. Lenders, if the sole purpose of you going for an interest-only term is to reduce the repayments, because essentially what an interest-only term allows you to do is only pay the interest, that is the rental of the property, and it doesn't mean that you're paying off the mortgage. Essentially, it allows you to have the lowest repayment possible. So lenders will want to know, firstly, why you're looking to do this. And if the sole purpose is to reduce repayments, to increase affordability and spendings with lifestyle, then the answer is no. However, if it's for a specific strategy, for example, the intention is to make the property an investment in the next year or two, then lenders will consider it and can see it as an acceptable purpose. The next commonly asked question is, how long can I choose for an interest-only term? Typically, lenders will allow between a 5 to 10-year term, and this discounts their line of credit products with. The next commonly asked question is, what is an example of an interest-only payment? Let's hop into the MoneySmart website and check that out. So what we've got here is we've got a $400,000 mortgage on a 4% interest rate, and we've got a 3-year interest-only period. What we can see here is that the repayments on this interest-only facility would be $1,333 per month. The next logical question a lot of people ask is, can I make principal repayments on top of my interest only? And the short answer is you can. However, it really depends on the product you're on. Some fixed rate products will limit the additional repayments you can make on top of your minimum, so you'll want to be cautious of that. Secondly, if the home loan product allows you to make unlimited additional repayments, then the answer is that you can make as much or as little repayments on top of the minimum as you'd like. When we look at that example again, what we can see is that we've got a minimum repayment requirement of $1,333 per month. And that was on the $400,000 mortgage at 4%. Now, if we want to make additional payments, anything on top of that will essentially go to the principal. So even if it's just $1, well, that's a $1 payment towards the principal. And the principal is essentially the loan amount. So the loan amount will reduce by $1. But you could make 10,000 or 1,000. Any payment on top of this minimum here would be considered a principal repayment. And the final question we get asked quite commonly is, can I pay my interest-only home loan off quicker? You can, so long as you're on the right product once more. So let's say you're on a variable home loan and you have the ability to pay off the home loan quicker. Well, in this month, you paid your $1,333 in interest, and you just so happen to have $400,000 lying by. Well, all you do is you transfer that into the home loan, and kazam, you've paid off your home loan. Again, providing the home loan product allows this, and you're on an interest only term, then that's completely acceptable. 3. The benefits of an interest only term. There are really 3 benefits in an interest only term. The first one's your repayments. Essentially, your repayments are at the lowest possible point and is a huge benefit, particularly if you're looking to do the second point, which is guarding your investment interest. So when you've got 2 properties, let's call it an investment and a owner occupied, what you really want to do is you want to funnel all your additional capital into the owner occupied home loan. Essentially, you want to pay this off as quickly as possible and leave the investment property alone. The reason is that the investment debt has taxation benefits, whereas your owner occupied property doesn't. So with reducing your payments, it essentially allows you to put the money you'd put into your investment debt here into your owner occupied debt and thereby paying it off quickly. And the final benefit is to free up cash flow. So if you're looking to save for another, save a deposit for another property, or you're wanting to go overseas for a little bit or needing some additional cash flow for other ventures, then it's another good reason for an interest only repayment term. 4. What are the disadvantages in going for an interest only term? Well, the first one is that on the Money Smart website here, the first issue is that you're actually going to pay a premium as a result of going for an interest only term. So we punched in the data again, same scenario as before. And the big thing you can see here is that you're paying a premium, in this case around $16,000 as a result of having a 3-year interest only term. The second is that your payments will actually increase significantly. Let's take a look at that. And here again with the same scenario. Now, the biggest issue is once the interest only term ends, your repayments will increase significantly. Now, typically with mortgages in Australia, you've got a 30-year term. However, your principal and interest repayments will be based on the remaining term left. So let's say you went for a 5-year interest only term. It'll mean you have a 25-year principal and interest loan term left. And we can see that your repayments will go from $1,333 in interest only up to a $2,111 per month, a significant increase. And essentially, the longer your interest only term is, the bigger this jump is, and a huge detriment to consider when looking at an interest only term. 5. The case study. Meet Joe and Ash. They were first home buyers and they were looking to borrow $1 million to secure their first home. They had approached us and had asked whether or not for the first 2 or 3 years they could go for an interest only term. You see, they found the repayments on the interest only very affordable. However, were a little bit hesitant whether or not they were going to be able to manage a principal and interest repayment. Because of the loan amount they're going for, it was a sizable amount in repayments. Our advice to them was this. It was to essentially reduce the amount you can borrow to what's in your limits on a principal and interest repayment term. It's because there's no point being able to afford an interest only repayment and in another 3 years' time for the same issue to happen once more. That is to say, for us to relook at their position and to look at whether or not they'd be in a position to afford the repayments at that point. I'm a big fan of always having people borrow under the limit to know where their comfort level is and to ensure that they don't just have a mortgage, but they also have a life, because there's nothing worse than having a mortgage and no life. So if you're in a situation where you're contemplating having an interest only term purely for affordability reasons alone, I'd say that that's the wrong way to use an interest only term. It's because interest only is always a short-term solution, and eventually you're going to have to go on a principal and interest term, particularly with more and more lenders making it harder and harder for people to extend their interest-only facilities. It's because when you do, a full application is required, and the bank's eligibility requirements will need to be met in order to extend your interest-only term. So, if you are in this position, it's wise to reduce the amount you're looking to borrow so it's within your comfort level, and it allows you to pay off your mortgage quicker rather than treading water for the foreseeable future. And remember to consider subscribing if you found there was value in this video. And that's everything from me. Here at Hunter Galloway, we're mortgage brokers who help people across Australia. So if you're looking for a good mortgage broker, we can help. Simply visit us online at huntergalloway.com.au or call us on 1300 088 065. Thanks for watching, and I'll catch you next time.